Hey, how's it going, everybody? So we've journeyed, from the bedrock of collateral to hidden plumbing of the financial system, and now we're going to arrive at the surface. We've made it to the surface, okay? The layers that everyone sees in the news. Layers 5 and layers 6, okay? The real financial interface, right? This is the real financial interface and the surface expression. So in the world of foreign exchange, so in foreign exchange we would say this is, commodities, okay, two M's, commodities, stocks, volatility, the axiom here would be kind of this crucial diagnostic principle, okay? So most visible markets that we come across, the most visible ones at least, which, we'll call equities, Forex, and vol, okay? They are derivatives of the underlying funding system. Okay, it's kind of a weird claim to make, right? Because we say, yeah, all those equities, all those indices and whatever stocks and companies and foreign exchange currencies, volatility, the VIX, all of those are actually derivatives of the underlying funding system. So that's kind of a crazy thing to claim, but this allows us to state something pretty powerful, which is that their price action, what makes them a derivative is because their price action is the symptom, not the disease. So a stock market crash is, you can think about it as a fever and not the infection, okay? The infection is almost always hidden in the plumbing of layers 1 and 2. So if we have funding crises and funding, problems, and we're getting a lot of, uncertainty when it comes to the repurchasing market, that's the infection kind of away, right? We haven't experienced the symptoms yet, okay? So let's start with layer 5, okay? So the interface, with the real economy, and this idea of a real economy is Forex and commodities, okay? This is real. It's a real economy, okay? And so, the US dollar is the world's primary invoicing currency, okay? Specifically for critical commodities like oil. So this creates, permanent kind of structural link between, economic activity, right, and dollar funding markets. Okay, the dollar funding markets that we actually discussed in layer 2. Okay, so let's make this concrete. If we have a Japanese shipping company, right, and they need to buy oil, the oil is priced in dollars, okay? So the company has yen. So if we have a simple flow, right, if we have, the Japanese company, let's say they have some yen, all right, and they need to buy some oil. And oil is literally denominated in dollars. So how does it get dollars to settle the trade? Well, of course, it has to use the FX swap. Okay? And so this is the bridge between, of course, the yen and dollars. The company would temporarily swap its yen for dollars, buy the oil, then reverse the swap later, right? And this means that the financing then of global trade is directly plugged into the health of the offshore dollar system, or the shadow banking system, right? So we see this interesting connection from all of the things that we've laid out before in our previous layers. It wasn't all for nothing, and of course, as Zoltan Bazar said, or as he's shown in his papers, specifically for the Banking of International Settlements in Switzerland, okay, a strain in the funding markets, right, visible in the cross-currency basis, right? If there's a strain in the cross-currency basis, what does that mean? Right? That means there's a shortage of dollars, right? It immediately translates to a higher cost of financing in real world commerce. This is very important to understand because most of the economic phenomena changing, costs and financing for real world commerce, it can be attributed mainly to this tension, okay? Now, let's talk about so let's talk about layer 6, okay? Let's move on to layer 6, okay? I kind of yapped a little bit about that one too much. But if we have the surface layer, right, that everybody watches, right? We can call this layer equities and volatility. Now, how are we going to relate everything to this? How can we possibly do this? Everything we've done is so abstract and plumbing and boring and finance, right? Well, equity actually represents something that we'd call a residual claim on a company's cash flows. Okay? This makes them very incredibly sensitive to everything that's happening in the deeper layers. Actually, the cost of credit as we discussed in layer 4, right? And actually the availability, so this was layer 4, remember? And the availability of liquidity in layer 2. Okay? But the most important instrument here is actually the VIX. Okay? And the VIX index is often called what we call the fear gauge. Okay? This is a misconception. Okay? This is not what it is. VIX is not an abstract measure of fear. By no means is it an abstract measure of fear. So, just to burst your bubbles, right? Everybody's saying this in econ class. It's just not true. It is not equal to fear. Okay? By no means is it. VIX is actually a concrete price. In fact, it is a price, the price of dealer balance sheet capacity. That's what the VIX is. Okay? So the VIX is the price of dealer balance sheet capacity. Okay? In our model, okay, that we've built so far. So when funding markets, right? Funding markets are stressed, right? When they get stressed, right? Stress goes up. Okay? Dealers have less capacity to actually intermediate risk. And so it becomes more expensive for them to hedge their books. And then, this cost is passed on to the market in the form of higher prices for options, which is what the VIX actually measures. Okay? So remember, funding markets, right? When the dealers have less capacity to intermediate risk, right? So dealers have trouble intermediating risk. Okay? It becomes more expensive for them to hedge their books. Okay? This is a little complicated, this idea of hedging their books, but just stick with me, okay? What happens is the cost of this, right, from them having trouble doing this, the cost, and from, it's passed on to the market, the cost of the funding markets, and when this cost goes up and the stress goes up, it gets passed on in the form of higher prices for options, right? So options, their price goes up, and that's what the VIX measures. A spike in the VIX, okay, is a direct quantifiable signal of stress in the plumbing underneath. Now, it might not happen right away, but typically the spikes in the VIX come from, these repo kind of tensions and these contagions in the repo markets. It's really, really important to understand. Okay, and not just repo, but it doesn't have to be just repo. It can be anything from L1 to L2, from L1 to L2, right, to L3 to L4 to L5 to L6. Okay, anything underneath. It becomes more expensive to hedge the risks. Okay, so this brings us to a unifying mechanism. Okay, we're going to try to unify everything, which is how a crisis will travel through the entire system, and how equities and volatility indices are, they are basically from a causal chain that propagates itself upward from the base. Okay, so we can think about this. Let's think about it like an analogy where we have, equities and the market implied volatility. You think of this as fever, okay? It's like a fever. And then, let's say we have FX, commodities, all right? And then let's say we have credit spreads, and then funding, and repurchasing markets. Let's say the infection happens here first, right? It's not visible yet, but the infection happens here first. And then, of course, the collateral, right? So remember what these were. These were L1, right? The collateral from terms of sovereign collateral. L2, and then L3, of course, was the central banking, but they're kind of a stop mechanism, right? And then we have L6. Okay, so crisis will begin with a shock, okay, to collateral quality or a run on the repo and funding markets. This is the infection in layer 2, okay? And so, the infection starts here with the shock there, and then the funding stress will immediately cause the liquidity premium and credit spreads to blow out in layer 4, as we discussed, okay? And then the credit crisis then manifests on the surface, right? Strained funding for trade will then disrupt the foreign exchange and commodity markets in layer 5, and then finally a forced deleveraging And a spike in the cost of the dealer, right, intermediation, will cause equity markets to crash and the market implied volatility to explode in layer 6, or the fever, right? That's what a stock market crash is. And we can show this again from our boys, right? Gordon and Metric, right? They do work on this, and specifically on their work on the 2008 crisis. They proved this. They showed that a direct statistical link between pure funding stress, okay, funding stress was LIBOR-OIS spread, a credit spread basically, or sorry, funding spread, not credit spread, okay, and they said that the contagion from the subprime mortgages markets, when this seeped into the repo market, it spread across all the other markets. So it's a fire. The fire is always in the funding first. Okay. So the framework reveals that looking at the stock market in isolation, right? If we try to just look at this stock market, right? Here's stock market. It's an isolated system, okay? When we look at it like this, and we're trying to diagnose a patient, right? We're trying to diagnose a patient by only looking at their temperature. You see the symptom, right? But you don't know what the cause is, right? So the inherent fragility of this entire hierarchical system, which becomes only starkly visible on the surface during crises, creates a powerful incentive, right, for innovators to try to build something new, right? Something outside the control of these established layers that we have. And of course, this is excluding L3, but it's not relevant here for crises, right? Because they are the control layer which tries to tame everything happening in the repo. But in the shadow market. Basically, we try to control. We're trying to describe here. Okay, we're trying to describe surface markets. Okay, layer 5 and layer 6 are surface markets. Okay, their price action is the symptom of deeper funding stress. Okay? And so the next thing that we would know from this is that foreign exchange and commodity markets link the real economy directly to the dollar funding system. Okay? So the real economy is linked to foreign exchange and commodity markets. Okay? With the dollar system. Okay? Everything is in dollars. Currency swaps are demanded, right? With some implied interest rates. They're demanded in order to buy, U.S. denominated oil, right? So, and also, equities are also the residual claim, okay? And the VIX of the dollar is the price of the dealer capacity, not the fear, okay? It's from the options market, all right? Contract market, the speculation market. So we would just say that the VIX here is the price of dealer capacity. Okay? And then, and let's move this over here. But the last thing that we want to show is that this entire fragile structure creates the incentive for our final topic, which we will talk about, is the search for alternatives. Okay? We have something really nice here. we've built some beautiful global kind of system, but there's a frontier, okay? And we're going to discuss this in the next episode. Thank you for watching so much.